Welcome to It's the Economy. Nifty Bank, with a 12% year-to-date gain, has been an underperformer compared to the Nifty, which has gained 20% in 2024. The big drag has been high deposit cost, fear of lower margins when the rate cuts begin. Now, HDFC Bank stock was also subpar for the same reasons. Today, I have with me a report from Santanu Chakrabarti of BNP Paribas, which is decimating both these arguments. Santanu has a buy on many big banks, especially on HDFC Bank. Big buy number, over 2,000 rupees. To explain his thesis and to put the market's fears to rest, I have the man himself, Santanu Chakrabarti, the India analyst of BFSI at BNP Paribas. Good morning, Santanu. I can't tell you how much you will be welcomed by many of you. Well, first up, the common thesis is that when the rates start getting cut, banks are going to suffer because their margins will decrease. Loan rates will come down. Tell us why you don't believe that thesis.
First of all, good morning, Latha, and thank you for having me. As usual, it's a pleasure to be here. Latha, I mean, there's a lot of validity to the argument that the moment rates get cut, especially since a lot of loans on the bank side are now linked to repo rates directly, there will be a pressure on margins. Now, that's a fair point, that the margin bottoming happens only after rate cuts. Where we believe that the market seems to have kind of lost the perspective a little bit is that what do those, the influences of those rate cuts are in the context of overall earnings. And the flip side of this is the same argument is applied to NBFCs, that, you know, NBFCs with a lot of fixed rate assets or even with a lot of fixed rate assets are huge beneficiaries. Now, in the overall scheme of things, what we have to remember is and this is the analysis that we have done, if we price in the rate cuts for the entire part on which repo rates apply, give the benefits of repo rates to all market-linked borrowings as well, then on a net basis, the total influence on most earnings, second half, is about 3 to 6%. Now, we have already been building in rate cuts, so these are not earnings estimate changes that we have made. But we wanted to give some context on what the overall number is. And what we also wanted to point out is that the margin bottom post the rate cuts sets the base for a gradual margin expansion from that point. And there are 3 or 4 major factors which drive this. One is that easier liquidity and a lower gap between savings account and fixed deposit rate means good things for CASA. Second, FDs also start to reprice. In a more growth-enabled environment, it is likely that more high-yield segments within the banking loans will probably go faster. So there's some support from mix as well. So on all of this sets the stage for a benign and gradual margin expansion, which, coupled with reasonable credit growth, translate into reasonable earnings growth. And that's the crux of our argument, that probably there's no reason to freak out about the rate cuts.
Fair point. So there's just a 3 to 6% impact on earnings is what you're saying. What would be the impact on margins, you think, for a marquee bank like ICICI or even for that matter SBI? The margins can go down by 10 basis? How much is the crunch?
For most of them, the total impact of this is 10 to 15 basis points. And this is without building in benefits that might well come in terms of FD repricing. If I just take the 2 primary drivers of margin squeeze, which is essentially what happens with the repo-linked loans, and only build in benefits that directly come into the CD part of their liability portfolio.
Yes.
Of course, what you're getting out there is an overestimate of the influence. But nevertheless, on the half-yearly earnings, it is 3 to 6%. That's what I'm saying. Not even on the full year.
You know, one point that doesn't get discussed enough, or maybe I'm making much about it, wouldn't there be mark-to-market gains? Look at the big fall in yields. I mean, 10-year went to 6.71 yesterday after the borrowing program came as expected. It is 6.73. But it is still so much lower, 50 basis points lower than what it was, say, 6-8 months ago. Won't there be mark-to-market gains?
Yes, there would be, but there are 2 parts to this story. Mark-to-market gains would be directly proportional to what kind of modified durations are these banks running. And this is where PSUs are positioned a lot better than private banks on this particular parameter. Because they generally run higher duration than what the private. Most private bank portfolio durations are like 6 months to 9 months, modified duration, which means what? That a 100 basis point swing is 0.6% to 0.9% gain on the. I'm not saying it's nothing, but it's not a make or break on the earnings trajectory.
Okay.
Right.
And the other doubt I had is why, I mean, what's your best estimate of when deposit rates peak? Have we already peaked, or do you think there is, perhaps one more quarter when deposit rates will be raised?
I think deposit rates have peaked for the most part. I mean, could there be from here on? So if we are expecting an October cut, between now and then over the next 20, 30 days, can one bank go out there and raise some rates in a bucket or no? This is very hard to guess. But for the most part, in any practical sense of the term, deposit rates have peaked. And interestingly, what you can see, Latha, is the backbook yields of the FD books of all of these banks have pretty much converged with what their incremental FD rates are, right? Which means that that's no longer a pressure point.
All right. Got that. Anyway, I mean, there are two views or many views on when the rate cut will come. There is Chetan Ahia of Morgan Stanley at one end who believes there's no rate cut at all. There is Samiran of Citi who believes the rate cut is only in April. And then there's Sajid of JP Morgan who expects it in December. Of course, there are some in the market who expect October, but that's a minority. Shantanu, why do you like HDFC Bank so much? Your target price is 2550, I think about the highest in the street.
Yes, it is, I think, at least since I last checked on Bloomberg.
Okay.
So this is very simple, Latha. I mean, given the setup that we have, and here we have HDFC, which has just merged, so its CASA has dropped, wholesale borrowings have gone up, there's loads of mortgages on the book, which would be all repo linked. So, the first reflex is very understandably that, look, this is one of the biggest sufferers of rate cuts. But if you really look at it, delayed rate cuts are actually bad news for HDFC, and I'll tell you why. Unlike other banks, HDFC has a few liability side cost improvement factors going just because it's coming off a very low base. For example, what people forget is that this is a bank which currently still has about 220,000 crores of NCDs, which are at about 7.9% yield on its book. So as this,
which were raised by HDFC.
Yes. So so as they expire, like even if you refinance it, for example, with a 7.25 MD, that's 65 basis points, right? So anything else, of course, it's much larger. Similarly, there would be some FDs raised by HDFC, which are still resident in there. This would be a smaller proportion, of course, but nevertheless, that's also a tailwind. They were carrying a level of liquidity which they probably incrementally won't need to carry. And remember that they're playing it very smart on the mix side. You have already seen news of them trying to parcel off as much they can of their mortgage loans through RMBS kind of structures. They have shrunk their wholesale book by 5.2% sequentially last quarter. So this tells you, and they have guided for a low growth, right? So this tells you they are very conscious about margins. And the rate cuts, what it does for them is it really addresses the bigger systemic issue of CASA, right? This is now a 27-28% CASA bank. If we actually calculate it as a percentage of total liabilities, which is NDTL, right? Don't go by what it is as a percentage of deposits. Go by what it is as a percentage of the liabilities. Right? Now, they have been sweeping up a lot of market share within all the incremental CASA that has come into the system in the last 2 years. The numbers are actually eye-popping. But it hasn't moved the needle on the aggregate. Why? Because there's precious little CASA which has come into the system, right? But now we have a situation where that CASA can accelerate. And even if they can hold 50-60% of their incremental market share performance of the last 2 years, you are set for a reshaping of the liability side as well. And finally, this has come to a 14.5% ROE bank already under the current liability structure. All it needs to do is get towards 16 to 17% over the next 2 years. And guess what their ROEs used to be before it merged? For the 5 years before it merged, they used to be 17%. The multiple at that time was 3.5. The multiple now is 2.1. So you draw your conclusions.
Yes. Fair enough. Very convincing. We just have to wait for them to show evidence. And, they have been gobbling up bulk of the deposits. That's the talk of the town. The other thing that plagues bank investor is when the rates fall, which are the banks that are most sensitive? I mean, which of them have more fixed rate loans, like auto loans, etc., and which are the more sensitive to rate cuts?
Right. So, the simple math of this is more fixed rate loans you have, less your margins will be impacted. But there's another part to this. The more fixed rate loans have, the higher the margin you're already started with. So, your fall is less, but the base is larger.
Okay.
So, for example, if you take, one example at the extreme end of this will make this clear for you. So, Bajaj Finance, if it makes 9 to 10% net interest margin, how are you going to ever call out an interest rate cycle on their margins?
Okay.
It's gone up 20 basis points, whether it's gone down 20 basis points, what impact does it have in earnings? And how are you going to tell? If I give you quarterly data of all the major NBFCs that are there in India, which are really thick margin, 8 to 10% net interest margin on AUM kind of businesses, you won't be able to guess what the interest rates are at any point in time. It's not guessable. If I just give you the margin number.
All right. Okay, I take your point, but that has also given me, you have given me the last question, which is why are you so positive on Bajaj Finance and on something we have heard less, Fed Bank Financial? Why do you like these two?
So Bajaj Finance is our topic within the NBFC space, and the reason is very simple. Look, in Bajaj Finance, as far as we are concerned, in order to think about multiples or what the valuation of the company should be, what we are looking at is essentially the customer acquisition pipeline and the upsell pipeline, and whether they can deliver on that in terms of technology and everything like that. What we are not worried about at all is whether in this cycle their credit cost is going to be 165 basis points or 190 basis points, and whether it turns in second quarter or whether it turns in third quarter. Because I don't think it has absolutely any relevance if the earnings growth of the business is running at 30% plus, right, for the next, and that looks sustainable for the next 5 years. Then, and at 24, 25 P, despite the run up, the IPO has triggered a run up. Let's be clear about that. But the point is, that is not the key question to answer. The key question to answer here is, on such a large base, given the high growth ask, can that be met or not? This little 20 basis point of margin and 10 basis point of credit cost, I think it's a fake, because it's an exercise in reason attribution just because the stock prices have not gone up. Because we saw such things with HDFC also, right? People were saying that they just can't get 5 lakh crore of deposit. But there are concerns, and then there is also fear, which is perhaps not as justified.
Oh, your fair point. Actually run out of time, but if Novak Djokovic loses a small game, it'll be more because his shoelace came off, but you don't doubt the quality of the player himself, like Bajaj Finance. Thank you very much, Santanu, for explaining both the macros and the micros of the banking and NBFC space, why he's betting so strongly on Bajaj Finance and why he's betting so strongly on HDFC Bank as well. That was the key takeaway from Santanu. That's it on this edition of Bazaar. Thanks so much for watching. After a break, Chart Busters.